Okay, so FIFO versus LIFO. These are ways that we're going to value our inventory. And this is going to help us determine what is the value of our ending inventory, what is the value, how much should we be recognizing as an expense for the cost of goods sold. Okay, so FIFO and LIFO methods, just inventory valuations, right? There are several methods that companies can use. There are weighted average, there's dollar value LIFO, there's all kinds of different stuff. We're going to talk about FIFO versus LIFO because these are the most common ones that you'll see, and quite frankly, they're the simplest out of all of them. There's less to make a mistake on. So FIFO. FIFO simply means first in, first out. It's the assumption that the first units you purchased are the first units you sell. The first ones in are the first ones out. Okay. The opposite of that is what we call LIFO. That's last in, first out. That's the assumption that the last units you purchased are the first units you're going to sell. Okay, so last in, first out. So let's take a look at transactions for Mario's Game Shop, and we'll use these transactions to calculate cost of goods sold and ending inventory based on LIFO and FIFO methods. So here you can see we've got a beginning inventory on January 1st. We make a couple of purchases. It gives us the number of units that we purchased and the cost of each of those units and a total cost. So our total available for sale, notice this is your COGS model right here, beginning inventory plus purchases are your cost of goods available for sale. So we know that our cost of goods available for sale is $10,000. Then in July and December we have sales. We sell them for $15 a piece. The number of units we sell, and then the total number of units we've sold. And finally, we have an ending inventory. Notice what it doesn't tell us here. What were the cost of each of those units we sold? What is the cost of each of those units that end up in our ending inventory? Well, depending on the valuation method we choose, whether it's FIFO or LIFO, these numbers are going to change. One's going to give us a higher ending inventory and a lower cost. One's going to do the exact opposite. It's going to give us a higher cost and a lower ending inventory. So the past table, we were looking at the COGS model. I mentioned that briefly. So beginning inventory through purchases, sales, and finally ending inventory. Cost of goods sold model is always going to be a good starting point, a good way to check yourself when you're doing these LIFO and FIFO problems. So as I mentioned, what is answered, what we don't answer with that table is what portions of the inventory make up the 800 units sold, right? How are we allocating the cost? And how are we allocating the value to the inventory? Okay, was it the beginning inventory that we purchased, the second purchase, was it part of the first purchase? And it really just depends on the method that you use. Okay, so most companies are going to use either FIFO or LIFO. They both make assumptions about the flow of inventory. However, and this is important, please note this, the actual flow of inventory does not need to match the actual flow of inventory. Okay, or excuse me, let me repeat that. The actual flow of inventory does not need to match the valuation method that you use. So just because you're a grocery store and your actual flow of inventory is first in, first out, you can still use last in, first out to evaluate your inventory. Okay. So let's assume, let's calculate our inventory amounts, so cost of goods sold and ending inventory using FIFO. FIFO is first in, first out. So your cost of goods sold is going to start at these first units, right? Your lower cost units are going to end up in your expense. Your higher cost units are going to end up in your inventory. What this means is you are going to, using FIFO, when prices are rising, you are going to have a lower cost of goods sold, which gives you a higher gross profit, which results in a higher net income. Okay. You will have a lower ending inventory, meaning the asset on your balance sheet is lower. Okay. So here we can see how we do this. Each one of these, think of these as a layer. And with FIFO, your first layer is going to be your beginning inventory. Okay. So on January, so we've sold a total of 800 units. Okay. So we're going to find 100 of them here at $7. That's $700. We're going to find 300 of them in the next purchase on April 25th at $9 a piece. That's $2,700. Okay. We still need to find 400 units. We're going to find those 400 in the October 19th purchase at $11 a piece for $4,400 total cost. That means our cost of goods sold equals $7,800. Now, We have 200 units remaining in our inventory at $11 a piece, so our ending inventory is $2,200. Here you can see the cost of goods sold model at work. Okay. So this is just a step-by-step of what we did. Pull the first 100 units from our beginning inventory. The next 300 come from our second purchase, or from our first purchase. The next 400 come from the second purchase. We add those up. That becomes your cost of goods sold. Since we know that our cost of goods available for sale is $10,000, you could simply take $10,000 minus $7,800. That's going to give you the $2,200 ending inventory. Or you could simply take the remaining 200 units at $11 per unit, and that will give you the ending inventory as well. So now let's look at LIFO. Okay, LIFO is the exact opposite. We're going to start with the last purchase. That's going to be where we find our first units that we're going to calculate cost of goods sold on. So with LIFO, your higher cost units end up in your cost of goods sold, and your lower cost units end up in your ending inventory. Okay, so with this, you're going to have a higher cost of goods sold, lower gross profit, lower net income, and you're going to have a lower ending inventory amount. Okay, so if we're going to calculate that using LIFO, we would take 600 units from the October 19th purchase. That's our first layer. That is $6,600. The next 200 units we find from the April 25th purchase. That's $1,800. That total those together, it gives us cost of goods sold of $8,400. The remaining 200 units are split between the remaining units from the April 25th. So there's 100 of those April 25th left. That's $900. And the beginning inventory of 100 at $7, totaling $700. So you have an ending inventory of $1,600. Another way you could find that $1,600 is we know our cost of goods available for sale is $10,000. Cost of goods available for sale less your cost of goods sold equals your ending inventory. And you can find it that way as well, simply using your cost of goods sold model. So just a couple facts real quick here. Nearly all companies are actually just going to sell their inventory in the FIFO manner. That's the physical flow. But they are allowed to report it as if they sold it in a LIFO manner. So they're selling it physically FIFO, they're valuating it on their balance sheets and their income statements in a LIFO fashion. Okay, they're going to decide which method that they're going to use based on a lot of different things. Okay. However, due to the potential for significant differences in cost of goods sold and ending inventory, investors and creditors have to be made aware of what method they are using and the assumptions that they're making when they make the estimates. This goes into the notes to the financial statement in the 10Ks. Okay, so the FIFO method. Typically, this matches the physical flow of inventory for most companies. The inventory, they like this because the ending inventory reflects your current costs, right? This is what we're currently paying for inventory, so it shows up in our balance sheet. That's why we refer to it as the balance sheet approach, okay? This concept right here will be important for you to remember. When you are purchasing inventory that is rising in cost, okay? So as you purchase inventory, it gets more expensive. The FIFO method will result in higher ending inventory and lower cost of goods sold, okay? This results in a higher gross profit. Higher the gross profit, higher your net income. The higher your net income, typically, the higher your tax liability at the end of the year. The LIFO method has expenses that reflect current costs. Okay, we refer to this as the income statement approach simply because your cost of goods sold is what ends up with the highest dollar value. Okay, it ends up in the income statement. The important concept to understand here is that when the cost of purchasing inventory is falling, right? So when it gets cheaper to purchase your inventory, the LIFO method is going to give you a lower ending inventory, the asset in your balance sheet, and a higher cost of goods sold, the expense in your income statement. This results in a lower gross profit, which turns into a lower net income, which in turn usually means you've got a lower tax liability at the end of the year. Okay, so here we'll just look at very quickly the balance sheet, ending inventory and balance sheet. These are the differences, right? You can see with FIFO we've got a higher ending inventory, and then on the income statement you can see that your gross profit is higher with FIFO, gross profit's lower with LIFO. Okay, so always pay attention to the COGS and the gross profit when you're examining each methodology. Okay, There may be many reasons why they report their inventory using FIFO. We've talked about a few of these. Okay, if they want to have an inventory valuation method that actually most closely matches their physical flow of inventory, FIFO makes sense, right? They may just like the way that FIFO reflects on their financial statements. They like the fact their shareholders like the fact that they have a higher net income number, right? That typically means they're getting paid more dividends because there's more retained, and there's more retained earnings after dividends are paid to reinvest back into the company. Okay, this is just a reminder. Okay, during rising costs, you have higher ending inventory, lower cost of goods, and higher reported profit. Okay, why would a company choose LIFO? Typically, tax savings. Okay, LIFO typically results in the lowest amount of reported profits when it's a perfect world, right? When inventory costs are falling. And then one thing to note, though, can a company have its cake and eat it too? Is what I put here. Can you use FIFO for financial reporting to increase your net income and LIFO for the tax return to decrease your net income? No, you can't. The IRS has established what they call the LIFO conformity rule, which just means that if a company uses LIFO for tax reporting, they have to use it for their financial reporting as well. Okay. So once you choose LIFO or FIFO, you're not allowed to frequently change from one to the next, right? Just because you want a higher net income one year and a lower the next year, you don't get to change. Okay. You don't need to use the same method for all of your inventory. You can value your grocery section at Walmart with FIFO and value your TV section at Walmart with LIFO. It doesn't matter. Okay? If you do have different methods, it doesn't matter what method you're using or how many different methods you're using. They need to be in the notes to the financial statements, and those are always in the company's 10K. So next video we'll start talking about credit sales and credit sales and uncollectible receivables. It's what we call bad debt. And then we'll also talk about the allowance for uncollectible